Good morning and welcome to the Killik & Co market update. It's been a bit of a strange week for markets. We've got this horrible situation in Israel, which must be impacting sentiment and how people feel, but so far the impact on markets has been surprisingly minimal. You might expect unrest in the Middle East to have an impact on oil prices, market volatility and overall market performance. So let's have a look at those three metrics in turn. Firstly, Brent crude. About 30% of global oil production comes from the Middle East, so any unrest in the region can lead to concerns about supply shortages and it can push prices higher. When the news about Israel first hit the headlines, we did see a jump in the oil price, but this was short-lived and it has since declined. Israel itself is not a significant player in the global oil markets, so hopefully the reaction of the oil price demonstrates that the conflict is not expected to spread further. To measure volatility, we can look at the VIX index, also known as the Fear Index, which measures expected future volatility of the S&P 500. This has actually declined over the last week and is far below where it was a year ago when the markets were reacting to rising interest rates and the UK's mini budget. For market performance, we can look at the MSCI World Index, which has actually risen over the last week, as you can see here. We'll be keeping a very close eye on these three metrics as this horrible situation unfolds. Also this week, there have been a couple of rather sensational articles in the press comparing the current state of the global economy to the time period that preceded Black Monday. Black Monday was a market crash in 1987, during which the Dow Jones Industrial Average dropped by over 20% in a single day. The reason for the comparison is that the time period before Black Monday was dominated by rising interest rates. So let's have a look at UK interest rates then compared to UK interest rates now. Here's a 50-year chart. Rates hit a record high of 17% in 1979, and they spent much of the 80s above 10%. That's very different to now. Rates now are expected to peak below 6% and to decline from there. For those worried about market volatility, it can be reassuring to look at a very long-term chart of equity performance. Here's the S&P 500 since 1969. Black Monday looks like little more than a blip on this chart, and the market had recovered within just 2 years. The chart highlights numerous major geopolitical events that negatively impacted the equity market. The 1973 oil crisis, the Gulf War, 9/11, the financial crisis, and the S&P 500 has recovered from all of these. There's quite a bit of detail on this chart, so please do contact us if you would like a copy. And finally, still on the subject of market performance, we've been comparing the performance of the S&P 500 to the performance of the Russell 2000. The S&P 500 focuses on larger companies and the Russell 2000 focuses on smaller companies. On a 2-year basis, the S&P 500 is flat, whereas the Russell 2000 is down over 20%. And this is a good indicator of how investors are feeling about risk at the moment. While smaller companies may have more potential for growth over the longer term, they are perceived as being riskier and more volatile, and when investors are feeling a bit nervous, they tend to have a preference for larger companies, which are perceived as being safer. Here at Killik, we do have a number of services focusing on smaller and medium-sized companies, so do give us a call if you'd like to hear about more of those. Next week, earnings season begins, so we've got lots of companies scheduled to report, including Netflix, Intuitive Surgical and Nestlé. That's it from us. Have a great weekend, and we'll see you next Friday.